What if I told you that one of the absolute biggest names in crypto isn't actually a blockchain? Kinda wild, right? Well, today we are digging into Hedera and its completely different approach to building our digital future.
All right, so let's just jump right in with the single most important, most surprising thing you need to know about Hedera. It is not a blockchain. And listen, that's not just some nerdy technical detail. No, it's literally the core of its entire design, its whole reason for being.
So that begs the obvious question, right? If it's not a blockchain, then what on earth is it? Answering that is really the key to unlocking everything you need to know about Hedera's potential.
Okay, let's get into it. First up, we're going to break down what Hedera actually is and how it was built from the ground up to tackle the very problems that blockchains, well, that they struggle with.
Okay, so at its core, Hedera is a public distributed ledger technology. You'll hear people call it a DLT. All that really means is it's a shared database, right? But here's the twist. Instead of a chain of blocks, it uses this patented algorithm called Hashgraph. Think about it like this. A blockchain is kind of like a single-lane country road, one car at a time. Hashgraph, it's like a massive multi-lane superhighway. This structure is what allows it to process a ton of transactions all at the same time, in parallel.
But you might be wondering, how does this web of transactions stay secure? How does everyone agree on what's true? Well, that's where Hashgraph's consensus mechanism comes in, and believe me, it is a total game changer.
It's actually a super clever two-step process. So step one, all the computers on the network, we call them nodes, they gossip about transactions. They just rapidly share info with each other. But here's the really cool part, the gossip about gossip. They don't just share the transaction, they share who they heard it from and when. This creates this super detailed history. Then comes step two, virtual voting. Because they have this perfect history, they can mathematically figure out what every other node would vote without anyone having to actually send a single vote. It's incredibly efficient.
And what you get at the end of all that is something called ABFT, Asynchronous Byzantine Fault Tolerance. Now that's a mouthful, but all you need to know is that it's the gold standard. It's the highest possible level of security you can get. We're talking a mathematical guarantee on the timing and order of every transaction. That means no forks, no do-overs, and no chance of a 51% attack. This is the kind of rock-solid, bulletproof security that big companies need.
And this is where the rubber meets the road. Look at these numbers. We're talking up to 10,000 transactions per second. Compare that to the typical 10 to 50 on other blockchains. It's not even close. Finality, 3 to 5 seconds, not minutes and definitely not an hour. And maybe the best part, the fees, a tiny, predictable, fixed fraction of a cent. For a business trying to build something, that predictability is huge. So yeah, it's faster, it's way cheaper, and it's incredibly energy efficient.
So the tech is obviously amazing, but that is only half the story. Because what really, truly makes Hedera different is how it's governed. And honestly, it's just as unique as the Hashgraph tech itself.
See, instead of having anonymous developers, or a single foundation, or a bunch of VCs calling all the shots, Hedera is governed by a council. And this council is made up to 39 huge, globally diverse organizations. And get this, they're all term limited, so no single company can just stick around and gain too much power.
And when we say huge organizations, we mean it. The list is just incredible. You've got Google, IBM, Boeing, Dell, LG, major global banks like Lloyds Banking Group and Deutsche Telekom. I mean, these are the actual entities running the consensus nodes. They're the ones voting on software upgrades. This provides a level of accountability and, frankly, legitimacy that big enterprises absolutely require.
Okay, so we have this crazy fast tech, and it's run by some of the biggest companies in the world. So where does the HBAR token fit into all this? Well, it has a few really important jobs to do.
First thing to know, the total supply is permanently capped at 50 billion. All of them were created right at the beginning, at Genesis. And that's it. No more will ever be created. This gives the network a really predictable, non-inflationary economic foundation.
Now, that initial supply was distributed across a few key groups: the team, early investors, the council itself, and the largest chunk was set aside for ecosystem grants to encourage development. The important thing to know now is that as of early 2026, a huge chunk, over 86%, is already out there in circulation. That really lowers the risk of some massive token dump suddenly hitting the market.
So this is absolutely crucial. HBAR is not just a token for speculation. It has real defined utility. Think of it as having three main jobs. First, it's the fuel. You need it to pay for any transaction on the network. Second, it's for security.
People can stake their HBAR to the consensus nodes to help secure the network. And third, it's a form of protection. Because every little thing costs a tiny bit of HBAR, it makes it way too extensive for someone to try and spam the network. So the more the network is used, the more demand there is for HBAR. It's that simple.
All right, so let's put on our investor hat for a second. What does all of this mean if you're thinking about HBAR? Let's quickly run through the bull case versus some of the key risks.
So the bull case is pretty clear, right? You've got that fixed supply, no future inflation. The demand is tied directly to real-world usage fees. You have this absolutely unmatched lineup of corporate partners. And it's carbon negative, which is a big deal. On the other side of the coin, though, are the risks. That governance council, well, it's a form of centralization. And unlike a lot of other projects, HBAR holders don't get a direct vote. Plus, it's up against some seriously stiff competition from all the EVM-compatible chains out there. And you've still got that last 14% or so of the supply managed by the Treasury.
When you really step back, Hedera is posing a pretty radical challenge to the whole crypto ethos of pure decentralization. It's basically making a bet that for true, mainstream, enterprise adoption, what the world really needs isn't total anonymity, but clear accountability. And that leaves us with one heck of a final thought to chew on. Is this corporate-governed model the real future of public networks?